Hi, this is Hutch with Life-Insurance101.com, and today we're going to look at the biggest buyers of life insurance in America, and that would be the major banks. We're actually going to examine their balance sheet to see how much money they have parked in permanent life insurance. We're also going to learn why big banks do this and explore how the exact same benefits can apply to both the small business and the personal financial level. With that, let's go to FDIC.gov, where any of you can access this as it's all public information. But I first want to credit the man who originally brought it to my attention, and that would be Mr. Barry James Dyke, author of the book Pirates of Manhattan. So first off, let's take a look at Bank of America's balance sheet. And a balance sheet by definition is an inventory of assets and liabilities. And all the big numbers over here on the right are even bigger numbers than they appear because they're representing dollar figures in thousands. If we scroll all the way down to line 41, what's interesting is how life insurance is titled on this balance sheet. They call it an asset. And if we look closer, we can see how much cash is parked in permanent life insurance policies. And even though it looks like 19 million, remember that it's actually times 1,000. So this is $19 billion. Now, this number isn't how much death benefit protection they have on the lives of their key executives. That would be an even bigger number. What this $19 billion actually represents is how much cash value or equity the bank presently has in the policies, even though none of the executives are dead yet. Let's take a look at another asset class that most people are familiar with, real estate. So if we look right here on lines 10 and 11, bank premises and fixed asset, other real estate owned, we can see that Bank of America has a little over $12.5 billion invested in real estate. Now, I'm not saying that you should be more heavily invested in life insurance than in real estate, but it is worth exploring why they would do this and how it could possibly benefit your situation. The first and most obvious reason is the death benefit protection. And if we look at the first asset listed on this balance sheet, well, it's total employees. I think it's a safe assumption to say that the most valuable asset of just about any company are those key employees. Yes, that's a key. Now, if a key employee were to pass away, the company would probably experience a substantial hit to earnings. However, the tax-free death benefit paid by a life insurance company could step in and save the day, making the company whole again. And this is even more important for a closely held business or a family than it would be for a big bank. But again, if it was simply the death benefit they were after, Bank of America could just pay for cheap term policies that build no equity. So what's with all these billions of dollars parked in permanent life insurance? For banks, their on-hand reserves allow them to operate and lend money. And I would say this need for reserves is even more prevalent in small businesses and families. So we're going to look at a few different asset classes that can be used when holding your reserves: CDs and bonds, stocks and mutual funds, and permanent life insurance. And we're going to look at them through the lens of how they grow, how they're taxed, and the protection aspects of them. So if we look at the growth curve for CDs or bonds, and this may be a little bit generous for CDs these days, it's not very volatile and just is supposed to grow nice and steady. If we look at stocks and mutual funds, obviously there's a much higher opportunity for growth, but there's also a lot of risk and volatility there. And what you don't want to be doing if you're a family or business is cashing out your stocks when they're down to handle a family emergency or float a payroll or buy equipment or vehicles or whatever. With modern-day permanent life insurance policies, you actually have the ability to participate in some market returns without all the market risk. So you can see your highs aren't going to be as high, but you're not going to have those devastating losses either. And just about every policy has a fixed-rate crediting option, similar to what you get in bonds or CDs, only unlike the CD rates you see at banks, your crediting rate from an insurance company isn't going to start with a dot. As far as taxes go, with CDs and bonds, it's real simple. You're going to get taxed every year on your growth, and you're going to pay that tax in the top marginal rate. With stocks and mutual funds, there's a good chance you can pay a more favorable capital gains rate, but you're going to get taxed every year these gains are realized. With permanent life insurance, all growth is tax deferred, and that's a big part of the reason why banks use this as a premier holding tank. And if structured properly, none of the distributions will be taxed if a death benefit is delivered. So for example, let's just say you built up a whole lot of cash value inside your policy over and above what you put in. And during the course of your life, you took these untaxed income streams for various reasons and left only a very small death check to be delivered to your heirs. As long as that death benefit gets delivered by the insurance company, the government doesn't go back and charge you a look-back tax on any of your growth or those distributions during that time. And that brings us to the final reason why banks prefer life insurance as a holding tank, and that's the death benefit protection. So if somebody important were to die, you get this wonderful multiplier effect of your cash value. Unlike CDs or bonds where the heirs would receive whatever the account values were, but there's no death benefit protection. And even with stocks and mutual funds, there's no multiplier effect. You're not going to get all the future expected growth that the stocks were going to earn over the course of somebody's lifetime. You're just going to get the value at that time. Now, going back to FDIC.gov, let's look at Wells Fargo's balance sheet just to show you that Bank of America is not the only one. And if we scroll down here to total real estate, we can see they have over $10 billion in total real estate. And scrolling down to life insurance assets, we can see they have over $17 billion in total life insurance assets. And it's not just the big banks, but also Fortune 500 companies that use permanent life insurance as a tool on their balance sheet. It's largely for the same reasons that you saw on the last slide. I've just found that consumers and small businesses haven't really explored.